First, let me introduce a little bit about Bogart Wealth for those who are joining us for the first time. So Bogart Wealth is a registered investment advisor. I like to say in the world of financial advice, there's two kinds of advisors, those who work for a bank and those who are independent of a bank and work only for you. So we're in that second category as an independent registered investment advisor. Our clients have their funds at Charles Schwab, and they give us a limited power of attorney to go into Schwab's system and buy and sell stuff and move money among their accounts. As it says here, over 700 households. This didn't get updated. We're over $1 billion of assets under management, and 90% of our clients are households that are major oil company employees or retirees. And I'll tell you, a major oil company means ExxonMobil, but that individual company would prefer we don't use their name too often. Okay, so as a registered investment advisor, we're a fiduciary. That means by law, we are required to always put your interest ahead of our own and provide full disclosure and the other things that are on here, but basically be very transparent and always act in good faith. We're a small company, 18 people, but I can remember when we were only half this big. So as our client base has grown, our staff has grown, including we have more advisors now than we did a year ago. And you can see from the pictures, most of those advisors are less than 40. I'm not one of those. So I retired from ExxonMobil in 2013. I hesitate because I almost always want to say I graduated from ExxonMobil. It just somehow feels more like it. But I retired in 2013. And right after that, we started getting a lot of questions about, should I be in the Roth 401k or should I stay in the traditional 401k? Because that was a new thing at that time. It just hasn't been around that long. The other thing that hasn't been around that long is for people in your income bracket to be able to do Roth conversions. That's only dated since 2010. So these are relatively new concepts. And we started getting that question, and I told the boss, I said, James, we ought to have a seminar on that. And he said, you go ahead and write it, and I'll give it. The other thing that we got asked a lot about is, can you guys do our tax returns? So we've added that capability in the last few years as well. We have 3 locations. We started off in McLean, Virginia, just a couple freeway exits north of the Gallows Road location, for those who remember that location. And of course, that location is no longer an ExxonMobil facility, moved down to Houston. We realized we need facilities in Houston and we need facilities in the Woodlands, so this is where we are. Our mission as a company is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. And what does that mean? It means that your parents, your kids can be big sources of uncertainty in your financial plan, and we're here to help your family to achieve financial security. The unhidden agenda of us doing these webinars is to convince you you want to talk to us and have one-on-one financial strategy session where we can get into your details like we cannot really do in a public forum like a webinar. Okay, the slide that doesn't want me to stop on it. So this Roth versus traditional 401k and IRA, the topic for today is one in a series of retirement readiness. So the original one was retirement planning timeline, followed closely by retirement income planning. And all the rest of these have been in response to your questions to us and your request to us for more information, getting deeper on each of these topics. So today's topic is going to be split into 3 areas. The first is, what are the basics of Roth versus traditional, of IRAs versus 401ks. After presenting the basics, then we'll reach some general conclusions. And then we'll talk about some special situations, which may be exactly the reason why you're here. And you're going to have to wade through the basics and general conclusions with us to get to those special situations. So in the basics, we want to make sure we understand the difference between contributions being made pre-tax and after tax. We want to make sure we understand the difference between tax deferred and tax free. And we want to understand what are the contribution limits, which are the big differences between IRA and 401k. We want to understand the different early withdrawal penalties and exceptions. So the exceptions to those early withdrawal penalties are very different by IRA versus 401k and by Roth versus traditional. And we want to understand what are required minimum distributions and how they differ among these different animals that we're talking about. So let's start with the idea of pre-tax versus after-tax contributions. Assume you're married and each of you has an earned income of 80,000. So as a couple, you're at the 160,000 combined income. That puts your marginal tax rate under current law at 22%. Okay, let's suppose that you've worked out your budget and you have, between the two of you, $20,000 to fund your 401ks, whether you have one or both of you have worked for a company with a 401k. With the traditional 401k, basically you're able to save all 20,000 of that. Your taxable income is reduced from 160 down to 140. With a Roth, you're going to have to pay tax. So if you really can only afford 20,000, only 15,600 is going into the Roth, and the tax is going out of the system to the government, $4,400. You do this for 30 years and assume you have 8% return. You're more willing to take risk as an employee than you will in retirement. Your traditional is going to be 2.2 million. Your Roth's going to be like 1.8 million. Okay. So the important takeaway from this slide is that your savings always come from the last dollars you earn, your marginal dollars, therefore taxed at your highest marginal tax rate. Okay, so as we said, after 30 years of this, you have 2.2 in the traditional, 1.8 in the Roth. So far the Roth is behind. Now let's suppose you're planning a 30-year retirement and you are going to be a little bit more risk averse as a retiree. So you think you're going to have 6% returns. So what can you withdraw? You can withdraw more from the traditional than you can from the Roth. But the Roth is tax-free and the traditional is only tax deferred. So if your tax rate is still 22%, which is about right for the traditional, then after tax, you're going to have 164, 598 per year. With the Roth, well, basically you're going to have the same amount. So the 164 with 22% tax taken out is the 128. So basically, if the tax rates are the same when you're working as when you're retired, then there's no difference at all between Roth and traditional. No difference at all if the tax rates are the same. Okay? So I'm just repeating what I said in the earlier slide to show you they're the same on an after-tax basis. But will your tax rate be 22% retirement? Well, okay, if your total income is this 165,000, then under current tax brackets, yes, the marginal tax is 22, but your average tax is only 17.1. Okay, so what it says is based on average taxes after retirement, marginal taxes as you're saving the money, using average taxes, you have more money with traditional. Okay, so what this is saying, if your tax rate is lower in retirement on average, it's going to favor the traditional 401k. This is just a table that's showing your average rate before retirement, or your average rate after retirement, your marginal rate now, and it's just demonstrating in numbers what I just said in words, is that if your marginal rate now is higher than your average rate after retirement, it's a losing proposition. If the inverse is true, it's a winning proposition. And if they're equal, then traditional versus Roth, exactly the same. Okay? If tax rate's higher in retirement, Roth. If taxes are lower in retirement, traditional. The progressive nature of the tax brackets favors traditional because, again, you're saving on a marginal tax basis. When you're taking the money out, the withdrawals are made of your average tax rate. Now, I'd have to say asterisks and footnotes to that, okay? The asterisk and footnote is, well, there's still Social Security, okay? So if you say Social Security is the base, then your withdrawal starts after Social Security. Oh, and some people take the annuity. Well, if you take the annuity, then your withdrawals here are starting after Social Security and after the annuity. So it's putting more asterisks and more footnotes as you go, but still leaning in the direction that progressive nature of income taxes favors a traditional 401k. Now, for those of you who just love the Roth and are itching to fight with me, just wait. I'm gonna get to your arguments in a minute. Okay, so now we're switching a little bit. Instead of talking about Roth versus traditional, we want to talk about 401k versus IRA. So 401k has much higher contribution limits. And okay, the employer match has been suspended. It'll be back. So there's two advantages to 401ks. So your contribution limit 2021 is the same as it was in 2020. 19.5 if you're not yet 50, and another $6,500 if you're over 50. And in a 401k, there's no income limits for a Roth contribution. So unlike IRAs. IRAs, much lower contributions, 6,000 if you're not yet 50, 7,000 if you're over 50. And there are income limits. We'll talk more about those in a minute. But there's no income limits for conversions. As I mentioned before, that's fairly recent. That's only been in the law since 2010. Now, you can contribute to both a Roth and traditional, but the limits are what's above, okay? And you can contribute to both a 401k and an IRA, but in that case, if you have a 401k available, whether you use it or not, if you have a 401k available, you're not going to get a tax deduction for the IRA. There are differences in early withdrawals. So in general, you know that there's a penalty for withdrawing prior to age 59 and a half, IRA and 401k. But there's exceptions. And the exceptions for an IRA include education, a 72T, which is a series of periodic payments over 5 years or more, medical, and a first-time home buyer. And a first-time home buyer doesn't really mean it's your first time. It means you've not owned a home in at least 2 years. Then you could be a first-time home buyer. The 401k has different exceptions. So it has the 72T, it has the medical, but this is the one you can drive a truck through. You're over 55 and you've already separated service from the company. Okay, retirement is the ultimate separation of service, but whether you retired or not, you're over 55 and you left the company already, then you can take money out of that company's 401k, even if you're working somewhere else and contributing to their 401k, without that 10% tax penalty. Okay. And Roth is the same as traditional. Okay. So the exceptions are quite different. You really need to have a strategy for your withdrawals prior to 59 and a half, if you retire prior to 59 and a half. Required minimum distributions. So just like the law says, they really don't want you to take money out of retirement savings accounts prior to 59 and a half. They also really want you to take this money out before you die. And nobody knows when you're going to die or how. And therefore, they enforce this in two ways. One way is this table of required minimum distributions. I'll show you the numbers in a minute. The second way is they deputize your custodian to rat you out if you fail to make these required distributions, okay? So these required minimum distributions force you to withdraw a certain percentage. The percentage increases with age. You can always take out more if you want to. The government's happy to have your taxes sooner. If you withdraw less than the RMD, again, your custodian is deputized to rat you out, and the penalty is 50 cents on every dollar you fail to withdraw, and you still have to withdraw it and pay the ordinary income tax on it, along with the next year's RMD. So you never want to miss an RMD payment, okay? RMDs apply to traditional IRAs, traditional 401k, and a Roth 401k. It does not apply to a Roth IRA. So if you have a Roth 401k, before you hit 72, you get that out of Voya or wherever your 401k is, and you roll it to a Roth IRA where you will no longer have required distributions, okay? All right, so these are the numbers. There's a proposal for a change, but as you can see from this graph, there ain't much of a change unless you live to about 105, in which case this proposal would make a difference. Okay, so the proposal actually a little better, but boy, it's not enough better to get very excited about. You can see this percentage goes up. So from about 3.6%, well, that's the old age 70. Let's call it 3.9% at the new age 72. And that doesn't seem so onerous. You know, 4% is a nice safe withdrawal rate, but it's going up and up and up and up and up. And look at this, in your 90s, you're getting up over 10% per year that you have to pull out. So they really want you to pull out every penny while you're still alive and in retirement. Okay, so we're going to move on now from the basics to the general conclusions. So basically, the conclusion, IRA versus 401k, use your 401k before considering an IRA, okay? So there's usually an employer match. There's definitely higher contribution limits. And if you're buying employer stock, there's NUA potential. Although I'll be honest with you, I haven't seen anybody get real excited about NUA since about 2015. But the stock's on the move. So, okay, NUA might become a hot topic again. So the factors which favor the Roth 401k, if your income taxes are going to be higher when you retire than they are now, okay? Or if you're still early in your career, or your kids are, and you want to talk to them about this, or tell them to watch this webinar, if you expect your salary to go up significantly faster than inflation between now and retirement, and why do I bring in inflation? Because all of the tax brackets creep with consumer price index inflation. So if you expect your salary is going to go up faster than inflation between now and retirement, do a Roth now, switch to traditional later as you move into higher tax brackets. If you expect income taxes are all going to go up in the future, for example, a lot of people say with the deficits we're running, taxes have to go up, okay? My only caveat on that is they don't have to be income taxes and they may not be in our lifetime. Look how long Japan has been able to run deficits and monetize the debt, and the yen has not lost value. I didn't say it didn't lose any value, but it still has value. So all income tax rates would have to go up in the future to overcome that effect that we noticed earlier, that the progressive tax system favors a traditional. Or another reason would be if you're going to have surplus RMDs. What do I mean by this? And I'll show you an example later. Your RMDs are so high that they're way above your spending requirements and they're pushing you into higher tax brackets. And basically, what I would say is one of two things are going to happen to everybody. If you live long enough, you're either going to run out of money or you're going to have surplus RMDs. Okay? So I would say this is the number one reason that we recommend Roth conversions to some of our clients. Or there's another reason, if you're going to leave a large legacy to your family, for sure, inheriting tax-free money is a better deal than inheriting taxable money. Okay, so those are the reasons that would favor you doing a Roth. What favors a traditional? If income taxes are going to be lower in retirement versus now. Okay, so let's say that the Democrats do what they say they're going to do. Nobody ever does, but let's say that they do exactly what they say they're going to do, and they only raise taxes on people who make over $500,000. If you're not making over $500,000 in the future in your retirement, then any increased taxes won't affect you. We already saw progressive nature of our taxation system favors traditional. Okay. Now, of course, there could be future tax law changes. If the Republicans got everything they claim they want, we'd have a flat tax by now. Or we could join the ranks of most developed countries and have a national consumption tax, a value-added tax. And that would definitely favor traditional over Roth, and it would be a way for the government to tax Roths. Okay, no income tax, but you still pay the same consumption tax everybody else pays. If you anticipate needing to draw down all or nearly all of your retirement savings, in other words, as I said, if you live long enough, one of two things happens. You're going to run out of money. You're going to have extinguished the money in your retirement accounts, or you're going to have excess RMDs. Well, if you anticipate needing to draw it all down in retirement, excess RMDs are not going to be an issue for you. Or if you anticipate leaving a large legacy to charity rather than family, charities don't worry about those income taxes. Okay, so we finished the basics, we finished the general conclusions. We're now on to special situations, which would be people who do have surplus required distributions, people who are asking questions about saving for retirement. Saving for education, that they have the option of a 529 versus an IRA, because remember, you can take money out of an IRA to fund education expenses. If you have already maxed out your 401k and you're asking, where do I go for savings beyond that? Or inherited IRAs, which are a totally different story. Well, not totally, but it's a different story from your contributory IRAs. So those are special situations, and so far, no questions. Okay. So as I said, surplus R&Ds, if you live long enough, you're either going to deplete your IRA, because again, those percentages are going up every year. At 105, it gets to 50% a year. It's really hard for an IRA to last very long when you're pulling out 50% a year, but of course, it's really hard to live past 105. So, or you will have required distributions greater than living expenses, or that is surplus RMDs. Now, again, going back to the idea that what we care about in retirement is your average tax rate, not your marginal tax rate. It's really hard for most people to have a large enough required distribution surplus to make their average rate in retirement surpass their marginal rate working, okay? So I'm just using the 24% tax bracket as the example for single, head of household, or married. This is the top of the 24% tax bracket. And how much money would you need to be withdrawing from an IRA to get your average tax rate in retirement up to 24%? So you would have to be pulling out a lot more money in retirement than you're pulling down in wages, salary while you're working. Okay, it takes huge surpluses. So who does this happen to? It happens to people who are really good savers. They're saving a large percentage, such a large percentage that they're never going to spend it all. And those are the people who really, really, really are going to have these large surplus RMDs and who really, really, really need to think about doing Roth conversions at some point. Okay. So if you're going to have large surplus RMDs, you might consider Roth 401k now, but a lot of these people are in really high tax brackets now, and they'll be in lower tax brackets in retirement, and that doesn't make sense. Or consider doing Roth IRA conversions now, but again, if you're already in a high tax bracket, you might want to put off your conversions until after retirement, but certainly before age 72, because at 72, you got required distributions forcing you to do withdrawals, and now you're going to do extra withdrawals and pay even more tax. That usually doesn't make sense. So it's kind of the time period between retirement and 72. And this is quite often the best option for somebody, is to put off your Roth thinking until the future. And there's always an asterisk and footnote, and that is, well, unless you're saving beyond the maximum you can put in your 401k, and in that case, okay, we're going to get to that in a minute. Or consider gifting. So that would be another way that you'd be pulling money out or using those excess required distributions, fund Roth IRAs for working children or working grandchildren. And in that way, you're still leaving the money to heirs in a tax-free environment. Okay, keep in mind the 5-year rule. I kind of skipped over this in an earlier slide to emphasize it here. For contributions versus conversions, there's 2 different 5-year rules. And I'll tell you, there's a lot of financial advisors who are confused on exactly this point. So for contributions, Roth, the IRA needs to be in existence for 5 years or more, okay? So you can put $1 in now, and 5 years from now, you start making contributions, and all of those contributions are gonna be already getting the full tax benefit. The problem is most people listening to this seminar today make too much money to make Roth contributions. For conversions, the conversion must have been made 5 years ago. So if you're not going to start your Roth conversions until after you retire, well, you better not need to pull the money out in the first 5 years, or you don't get the full tax benefits. Okay, so we have a decision tree. Should you convert? Should you not convert? You know, basically, do you think your tax bracket's going to be higher in the future? If yes, okay, we consider it. If not, think of something else. Okay. Do you expect to start withdrawals after 5 years? Are you going to be able to wait those 5 years? If not, maybe not doing it wrong. okay? Uh, if doing the Roth is going to create additional taxes, can you pay those taxes out of pocket, or do you need to pull out more money from, say, an IRA to do a Roth conversion? If the answer is you don't actually have money to pay the taxes, you need a little finer pencil to make sure this makes sense. Okay, so here's an example of someone for whom we recommended doing Roth conversions early in retirement. So their base plan said that their tax rate is going to be, well, they're still working in 2020 and they're at the 37% tax bracket. And you go, they're very lucky people. Okay, their first years of retirement, they have after-tax money to live on. They're going to be down here in the 10% tax bracket. And then over time, they're creeping up and then jumping up at age 72. And as those percentages go up over time, their marginal tax bracket gets all the way up to 35%. This is under current law. So what we said is it's kind of a waste to only pay 10% tax, but be forced to pay 35% tax later. So could we do some Roth conversions in this period of time to pull that tax rate down later on? And whenever you're doing something like this, you're voluntarily paying taxes sooner than later. There's always going to be a break-even point. You have to live long enough to get the benefit of it. So that's another thing to keep in mind. But here was their base case. They had a little bit of money in a Roth, so it was growing over time. And they were going to end with 170,000 in a Roth out of a total portfolio of almost 13 million bucks. What we came up with the strategy was to bump up against the 22% tax bracket. So they'd be doing conversions of 175 to 200,000, changing a little bit every year as their tax situation changed. So total of making another contribution of 700,000 into the Roth that grows to 3.2 million. And the proof in the pudding that their total portfolio ended up larger out here at age 90. Okay, so you'd kind of have to look at, okay, at what age did they break even on this scheme to pay more taxes early? Okay, we call the base case, we call this one the bump case, bumping up against that tax bracket, showing that their required distributions dropped significantly, dropped by hundreds of thousands of dollars over time. Their tax dollars that they paid were a lot higher here, but then a lot lower out here. Okay. Again, you'd have to look at how long do you have to live to break even. So the impact on taxes, now here, this is not the marginal rate, these are average rates. So instead of paying rates less than 10%, then they're paying rates here around 16%. But in this case, it's going up to 25, 26, and in this case, it's staying below that. Okay, so I'm not seeing any questions on the Roth conversion. You get the idea, you're paying taxes sooner, which is why the government lets you do it. They want your taxes sooner in order to save taxes later. So changing topics now to the 529 versus the Roth. So a 529 has a lot of advantages. There's no income limits. There's no tax at all on withdrawals for qualified expenses, and the annual contributions are much higher than they are for an IRA. But it has some limitations. So one is that you're going to pay taxes and penalties. When is the break-even point? Back on Roth conversions, the question is, what is that break-even point? And the answer is, it depends on the individual and the individual situation and how much more tax we're having them pay now and how much tax they're saving later. But generally speaking, probably about 85. And it just happens to be a magic number that's probably your life expectancy. So, so in other words, for half the people, you're going to live beyond that, and half of them you won't. But if you're a married couple, there's a really high probability one of the two of you will live past 90. Okay? Not both, but one of the two. So it's still probably good planning for a couple, and particularly if your desire is to leave money tax-free to a future generation. Okay, so back to the 529 plan. There's limitations. You're going to pay taxes and penalties if the expenses are not qualified. Okay, and they're considered assets on a student aid application, FAFSA, if the parent holds it. Okay, if the grandparent holds it, it's a different story. And isn't that nice when you can get the grandparents to pay for your kids' education? But okay, you do not want to overfund a 529 because then you might have to kind of jump through hoops to find qualified expenses, like that training course you wanted to take on being a golf instructor that you have to go to Scotland for. Okay. The other thing, of course, is you can always change the beneficiary of 529. So you don't have to have one for each kid. You can have one and change the beneficiary to another kid if the first kid didn't spend it all. Okay, so generally you want to fund the 529 plan first, but to avoid overfunding, you might consider, for example, making Roth contributions or Roth conversions, because the contribution or conversion can always be pulled out tax-free and penalty-free for qualified education expenses, not the gains. Okay, for that, you had to wait the 59 and a half, you had to wait for it to be in there 5 years. But the contribution can be pulled out tax-free and penalty-free for qualified education expenses. And IRA assets are not disclosed on a FAFSA, filing for financial aid, because those are not for education, those are for your retirement, okay? So a Roth IRA, but not a 401k, can supplement a 529 savings plan. All right, now for those who have more money to save than they were gonna save in the 401k. So basically the 401k, again, 19.5 if you're less than 50, and $6,500 of what they call catch up. Whether it's catching up or not, it's called catch up if you're over 50. And the maximum from all sources. So that means if there were an employer contribution, it means the combination of your pre-tax and after-tax contributions, the maximum of all of those is $58,000. Again, plus $6,500 if you're over 50. For the contributions in excess of what you can do pre-tax, then basically what we would say is put it into a traditional IRA and do a Roth conversion, which can be tax-free if you have no other IRA. So when you hear about the backdoor IRA, the backdoor Roth conversion, it only works if you have no other IRA. When you hear about the mega backdoor Roth conversion, that's in the 401k, and it's if you have no after-tax account, no after-tax money at all in your 401k plan, then you can do the mega backdoor conversion, okay? Or you can do additional after-tax contributions to the 401k, and when you retire, and you do a lump sum distribution from the savings plan, your after-tax contributions can then roll over to a Roth IRA. Even though you never put them in a Roth 401k, after-tax contributions can roll over to the Roth IRA. Not the gains on those contributions, just the contributions themselves. And so that's the argument about, do I just make after-tax contributions, or do I make sure they got into the Roth 401k? If you got the money into the Roth 401k, the gains on the contributions can roll to a Roth. Otherwise, it's just the contributions themselves. And the very last choice is a taxable investment account, because every time that you change your asset allocation in any way, if you have a capital gain from that, it's taxable. And, that just really hurts, particularly if you're in the peak of your career income, you're at the peak of your marginal tax bracket. You really don't want more taxable investment income. You really don't want that. So saving it in one of these qualified accounts is a better deal, but clearly individual circumstances are going to determine what's the next best option. And we're really happy to talk to you about it one-on-one about that. Okay, so traditional IRA accounts, I already mentioned a couple of times, the limit, 6,000 or 7,000 if you're over 50. No income limit if you don't want a deduction, okay? Now, if you're covered by a plan and you actually want to get a deduction, if you're covered by a plan, then there's a phase out in terms of how much of a deduction you can get or how much of it can be deductible, let's put it that way. If one spouse, if you're married and one spouse is covered by a plan, the other one who's not covered by a retirement plan like a 401k, they have higher limits for phasing out the ability to deduct those contributions. So most of our clients are above these kind of numbers, either as an individual or as a couple. And so they have non-deductible contributions only, which is okay. You make those contributions, and if you have no other IRA, you immediately convert those to a Roth, and you got no deduction, but you got money into a Roth despite being above Roth IRA contribution limit. So here's the Roth IRA contribution limits. You cannot contribute a single dollar to a Roth IRA if you're above the upper limit. At the lower limit is where they start to restrict how much you can contribute to a Roth IRA. But Roth conversions have no income limit, and that's been true for the last 10 years. Okay, so I've already mentioned backdoor Roth contributions. It's just a picture of it that you would put in after-tax money to a traditional IRA. And if you have no other traditional IRA anywhere in the world, then you can do this backdoor Roth conversion. Now, I know a lot of financial advisors who kind of forget that anywhere in the world piece. And they'll do this for you, even though you have another IRA someplace. But I'm telling you, the IRS is going to catch you, and they're going to come and tell you you owe money on that. From an IRS perspective, you only have one IRA in the world. You can split it into as many accounts as you want. You can put it in as many different brokerages or banks as you want. It doesn't matter. You only have one IRA. 401ks are different. Each one of them is a unique plan. So I know it's confusing when you first come into these things. Okay, we're switching now to inherited IRAs. And this got a lot more confusing in the last year with the Secure Act coming out, okay? So you now have eligible designated beneficiaries designated beneficiaries and non-designated beneficiaries. And they have a different set of rules. So basically, the most common designated beneficiary is your spouse, okay? And it says stretch still applies. We'll get into what that means, but basically they can stretch out the withdrawal of that money for the rest of their life, okay? But it also includes your children, as long as they're minors, or if they're disabled or chronically ill and not more than 10 years younger. Okay, so minor children would be the second biggest category of these designated beneficiaries. So everybody else who's not designated, eligible designated, is just designated if you named them as an individual. Now, if you didn't, like you put it into a trust that did not name the beneficiaries of the trust, or you left it to your estate, or you leave it to a charity, then they're not designated. So this difference is the difference between 10 years to empty the account and 5 years to empty the account. If that's a Roth, they're emptying the account but pay no taxes, but they lose the protection on the gains from that point forward. If it's traditional, they got to pay tax. Okay, so they have 10 years to pay tax on $1 million inheritance, or they have 5 years to pay tax on $1 million inheritance. That's a big difference. Okay, so inherited Roths, your Roth IRA has no required distribution, but inherited Roth does, okay? If your spouse is the beneficiary, they can either roll it to their own Roth and have no RMDs, or they can treat it as an inherited Roth. Now they're gonna have RMDs, but they're gonna have no 10% tax penalty. So this would be, you know, if your spouse is younger than you, well, they don't have to be younger than you. Let's just say you pass when you're past 59 and a half and they're not. Oh, I guess that means they are younger than you. Okay, then they can take it as an inherited Roth and not pay those 10% penalties for early withdrawal. Whereas if they moved it to their own, that's better for their life, but it's not so good for right now. So that's kind of their two options. Non-spousal beneficiaries, it's always going to be treated as inherited. So that means they can take money out right away. It also means they have to take money out right away. Okay. So withdrawals from an inherited IRA can begin anytime. There's no 10% tax penalty. Okay, but only eligible designated beneficiaries can choose and are required distribution based on their own life expectancy. That's a stretch. So that would be your spouse, minor children while they're still minor, disabled or chronically ill, and all others are going to have to take everything out within 10 years. So again, the individual circumstances are going to determine the best alternative. Anybody in your family who needs to make that decision, we're happy to work it through with them to figure out the best alternative for them. Okay, so to summarize everything, it's complicated. We're happy to run the numbers and help. So there are a lot of factors that are going to determine traditional versus Roth. There's a lot of factors that are going to help you decide, should I be doing a backdoor Roth? Should I be doing a mega backdoor Roth? You need to consider your current versus future average tax rates. Nobody knows that, but we can help you estimate it. We can show you what it looks like under current law. We can do what ifs under different scenarios if you want. When you're choosing Social Security, and that's another one that it's like very individual specific, and we can run those numbers for you and help you determine what's the best for you as an individual or you as a couple if you're married. Do you want to put the savings in tax qualified or after tax accounts? We have a huge preference for tax qualified, but if you're bound and determined that you want to retire before 59 and a half, it's really, really good to have some money in after tax accounts. So again, something for discussion. What do you expect your RMDs are going to be relative to living expenses? You need an entire financial plan to know that. That's what we do. No cost. Future tax law changes. Well, you know, we don't know those any better than you do, but we think about it all the time. So we're happy to chat with you and talk about what are the scenarios you'd like for us to look at. And then estate planning and legacy considerations. So we have no lawyers on staff. However, we have a lot of experience in helping people think through their estate planning, and they can have it all flow charted out to take to the lawyer. And by the way, if you're an ExxonMobil employee and you're still employed, you have a benefit of getting a free will. So that's not the same thing as exercising your free will. You know, that's a whole other story. But you have the benefit of getting a free will. What I would do is an intranet search for legal services, or if you want to start in the right place, go to EHAM. Okay, it's not a mental health thing, but it's in that basket of services that comes along with EHAM, the free will. And I've never heard anybody complain that they got a rotten job out of that service. So I think that's a good referral to you. Again, the not hidden at all objective of us giving these free webinars is your education and encouraging you to come in and have a discussion with us one-on-one, see how these principles apply to your situation. And thank you.